Hi, my name is Anubhav Srivastav and welcome to a new edition of Business Brewery. Today we're going to talk about the changes in the finance bill, specifically with reference to debt funds that were introduced towards the end of the last financial year before the finance bill was passed. Here are the 5 things that you need to know when you get into debt funds, or if you already have debt funds with you, or if you have gold funds or international funds, or pretty much any fund that has less than 65% investment in domestic equities, that is Indian equities. The first one, what are the changes? Earlier on, you could have you could pay tax on your debt fund gains based on an indexation benefit that you were getting, which means that all the inflation for your holding period came out to you tax-free, and anything above that you earn will be taxed at 20%. Now, all the gains that you have coming out of a debt fund or other non-equity funds will be taxed at your income tax rates. That's the first one. So what happens to the investments that you already hold in any of these funds? The first thing to understand is that all of these things are grandfathered. What does that mean? That any investments that you had till the 31st of March will be taxed at the old regime, which means that you do get capital gains and indexation benefit for all of those investments. However, from the 1st of April onwards, if you have any investments in all of these funds or any of these funds, they will be taxed at your income tax rate, right? That means that the gains will be taxed at your income tax rate. So, does this affect everybody? Well, not really. Anybody whose income tax rates are below capital gains tax rates in the earlier regime actually stands to benefit. So if you have an income up to about 10 lakhs, you could potentially get tax at your income tax rate, which is kind of lower than the erstwhile capital gains tax rate. So does not really affect you. If also you were using debt funds or similar funds for short-term cash management purposes, which means you are anyway paying income tax rates out there, nothing changes for you. However, for a large portion of us that are in the middle of all of this, we do end up paying a higher tax rate. So that's your third point. The next issue is, how is this then therefore different from fixed deposit, bank FDs, if at all? Well, interestingly, bank FDs are taxed on an accrual basis, which means that all your interest that you have earned but that's not been paid out for the year will get added to your income, and you pay tax on it at your income tax rates. For debt funds or gold funds or international funds or any of these funds for where the tax regime has changed, you will only get taxed when you redeem these funds, so you sell those investments. Right, which means that you do end up compounding all of these things. Even though you eventually pay the same rate somewhere down the line, you might gain if your compounding is good enough over a longer period of time. So the question then arises, should you invest in any of these things at all? Is there any purpose to investing in any of these funds? Well, the short answer is yes. Because all of these funds are weakly or have low correlation to equities as an asset class, it makes sense to add them to your asset allocation irrespective of how the taxation changes going forward. How much should you add? What that should be? I think you should do some research on it or have a word with your investment advisor to get that number sorted. The second interesting thing is the tax on holding bonds actually does not change directly. Now, if you buy a bond today and it is listed, what happens is that your capital gains that are coming out of the bond actually give you long-term capital gains benefits if you hold the bond directly after 1 year because it's listed. However, all the coupon or the interest that the bond pays out on a half-yearly or a yearly basis or whatever that payout period is, you will have to add that to your income and pay income tax based on your income tax rates on it. Now, in short, that's the gist of what the tax changes imply. If you need to understand these things more in detail, I'm going to add a link to my column in the Deccan Herald on the subject down below. Do have a look, leave your comments, suggestions or even questions in the comments of this video. I will see you again soon with another interesting topic on personal finance. Till then, bye.